And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story, real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the show. Of course, it's the second best day of the week as we get the Thursday edition of the Real Investment Show underway. Of course, Michael Lebowitz joining us this morning to talk all about the Fed. So we'll go through everything the Fed did yesterday, hiking rates, and of course, creating the most volatile 90 minutes of the market in market history. Immediately after the rate hike announcement yesterday, stocks actually surged up about 30 points or so, and then Powell spoke, and the markets ended down almost over 2% yesterday. So a very wild swing in that last 90 minutes of the markets yesterday. There is no really good news to point out of this. We broke yesterday back through the 50-day moving average. We broke through support at 3,800. We're now testing the 20-day moving average. That's going to be on the agenda this morning. Dow currently pointing down about 150 points. Nasdaq's down 87. S&P's down about 23. Now, this is futures at the moment, so maybe we'll get a little bit of a bounce this morning. We'll see. But again, the sell-off yesterday pretty much puts this entire rally that we've been in for the last 4 weeks at risk. And again, you know, one of the big challenges here is now as we head into the end of year, we have a lot of portfolio managers, of course, as well as retail investors holding on to a lot of cash at the moment, you know, because they've been selling stuff and now they've got cash. What happens with that? And of course, you know, this whole rally that we've talked about to sell into, and you know, we had sold some stuff a little bit earlier this week. You know, this is the threat here, of course, and we've talked about this issue before. Is that, you know, a lot of this was going to hinge on both the Fed as well as the midterm election outcome, which is next Tuesday. So potentially we might get a little bit of reprieve from the selling next week after the midterm elections. If we start to see a gridlocked, you know, kind of Congress, that may help bode a little bit well here in the short term. We also move into the holidays after that, so trading's going to get fairly light here fairly quick. So again, you know, yesterday's action, not positive really on any front. If there's any signs of really kind of good news, I guess, out of the action, we've had a very long stretch of stocks making new lows. That is something that you don't historically see that can, last for very long. I mean, just once you start getting a large majority of your stocks making new lows, you're starting to wring out a lot of sellers in the markets. And again, that's one of the real questions here is that, you know, we've done a lot of selling. There's been a lot of selling pressure on markets. Valuations have come down markedly for stocks. And the question is really just how much more is there left to continue to wring out of these stocks. And of course, you know, you can make an argument either way, depending on what your view is. But going back to what we talked about the other day, while, you know, the markets are under pressure, and it's certainly a very, you know, kind of draining environment at this point emotionally, you know, it's important to keep some perspective here, though, as well. Stocks really haven't done anything now for the last several months. In fact, we just kind of keep going back and retesting these lows that we set back in June. The question is going to be whether or not they're going to continue to hold here. That's, you know, this is going to be the big challenge as we look forward. But again, it's important to keep things in perspective. Markets have just really kind of, you know, worked within this range of just kind of going sideways. We've broken out to the upside of it. We've broken to the downside of it. But ultimately, we kind of keep coming back and just forming this kind of base in the market that has been continuing just to provide some support. So again, you know, it's not that, you know, you shouldn't be cautious of this environment. Markets can certainly break lower from here as we go into next year. But again, just important to keep a little bit of perspective about what's really going on so we don't make you know, a lot of emotionally based decisions in portfolios, because that's very easy to do. But importantly, you know, again, as we take a look at the markets itself, you know, that's the overall market. Internally, there's a lot of stuff that's really happening. A lot of stocks are making new lows. Companies are getting hit fairly hard here. A lot of selling. You know, this earnings season has not been great for companies, and it was something that we had talked about previously, is that expectations were too high. Those expectations and those forward expectations for earnings are now coming down very quickly for a lot of these companies. So again, as we've talked about and warned about, as these expectations were coming in, companies have been missing earnings, missing revenue growth, and they've been punished very hard for that. This has been one of the most brutal earnings seasons for companies really in recent memory, where the punishment rate for a stock that misses sales and or earnings, or both, has been fairly brutal. Stocks, down 15, 20%. We saw that with Meta and other companies as well. They missed earnings, missed revenue, or just gave poor guidance. And these stocks are down 10, 15, 20% the next day. So again, a lot of volatility in this market in terms of individual names, a lot of downward pressure on portfolios, really kind of across the board. And this is where it gets really challenging, for investors. Outside of that, some other interesting news. Elon Musk, of course, taking over Twitter on Friday, is now announcing as much as 50% of the Twitter workforce, that's about 3,500 employees, will be fired. So this is going to be a really interesting, aspect that comes out of this. Again, it's interesting. He's done a couple of things lately, and this makes complete sense. First of all, I was doing Charles Payne on Wednesday, and he asked me, he says, Lance, you don't have a blue check mark. Why don't you have a blue check mark? Well, I applied for a blue check mark years ago, right? Couldn't get one. Never would give it to me because basically I was doing political talk back then, and they didn't like the fact we did conservative politics. So they wouldn't give us a blue check mark. It's okay. But now they're going to charge, Elon Musk is now going to charge $8 a month. If you want to maintain your blue check mark, that's awesome. It's going to cost you $8 a month. Now the question is how many people are going to actually pay $8 a month just to maintain a blue check on their Twitter page, right? That's going to be the question. But this is the challenge that Elon Musk is now going to face with Twitter since he took it private. And the question that Charles Payne asked me is like, well, why is this a good idea? It's like, yeah, he's got to do something here because now that he's taking the company private, right? He overpaid for this company to start with, paid $44 billion for it, whatever the number was. Well, that was based on market capitalization and valuation. So that was what investors were attributing the value of the company to be. $44 billion is a lot for a social media company, right? Just in terms of value. So he overpaid for this company in terms of market capital valuation, took it private. So now the company has to be worth $44 billion all on its own. And that means you don't get that outside benefit from public investors. So he's got to cut costs. He's got to create revenue streams outside of advertising as well. And of course, the liberal left now that pretty much dominates the majority of Twitter. They're doing their campaign to get advertisers to quit advertising on Twitter, to try to get people to turn away from Twitter. So this is going to be a real challenge here for Elon Musk to, as a private company, to make this actually just a profitable company. Now, eventually, he'll take this company back public again, because in order to get that valuation back out, right, to try to take $44 billion and try to make some money on it, you're going to have to go back out public, be a public company, get that market capitalization premium for the company at that time. So again, but in the meantime, if he can turn this company around, make it profitable, create new streams of revenue for it, grow its advertising base, as well as grow its users base, which is what he's trying to do, and then takes it back public, he can certainly turn around, make some money on Twitter. But first order, of course, though, is to get rid of all the bloated overhead. And one of the interesting things about the layoffs that he's doing is that one of the metrics they're using to look at these layoffs is how much did you actually contribute to the code of Twitter. And also, if you've been working remotely and want to keep your job, yeah, you have to start going back to the office. So, this is a new trend for companies. Come back to work if you want to keep your job. All right, we got a lot of stuff to get into this morning with the Fed. Jerome Powell, of course, really just throwing cold water over the initial Fed announcement yesterday, but made some interesting comments about QE and zero rates, and we'll talk about that as well. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The end of the year is fast approaching. What will the new year bring? Join Richard Rosso, Danny Ratliff, and Lance Roberts for our year-end economic review special event, Tuesday, November 15th. How to address higher taxes in the new year. Should you delay your retirement in 2023? What will the midterm elections mean for markets? Register now at realinvestmentadvice.com for our year-end economic review special event with Ratliff, Rosso, and Roberts. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN, or again, simply online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
Welcome back to the show this morning. So, interesting story very quickly about the World Series and the Phillies last night. So, the Astros had a no-hitter last night. First no-hitter in a World Series since October 8th, 1956. So, pretty amazing turnaround after a 7-0 shutout in the last game. But one of the interesting things, and if you don't live in the Houston area, everybody that lives in Houston knows Mattress Mac, right? He is... Mac McInville has been a Houston icon for decades now. Big contributor to a variety of great organizations, a big supporter of Houston charities, a big supporter of Houston sports, right? Whether it's football, baseball, etc. And what he's known for is making these kind of wild bets on, I shouldn't say wild bets, these are very calculated bets on outcomes. And the stick is basically, hey, come to my furniture store and buy a bunch of furniture, and there's a limit. So you have to buy, in this case, it's the Stearns & Foster's or some mattress that he has at Mattress Mac. Buy $3,000 worth of a mattress, and if the Astros win the World Series, if they win it all, you get your furniture for free. Right? And he's done this multiple times. He's done this for football games and a whole variety of other things. But these are calculated bets. And of course, yes, he has insurance just in case things go wrong. But this year, Mattress Mac now has a $10 million bet that the Astros are going to win the World Series. So he is into this $10 million deep this year. So he won $15 million on the last bet, by the way. So he's only kind of gambling with house money. But... You know, this is just kind of very interesting, and it's 2 games up right now. So this is, the best of 5 series out of 7 games, and the Astros going into this had a 94% probability of winning the World Series. So now that it's 2 up, I'm not sure those odds are at the same level anymore, but we'll see. But yeah, $10 million bet on this, so we'll see how he does. Again, he has insurance. Don't worry. Yeah, even if he lost all $10 million, he's fine, right? He's made millions of dollars selling furniture. And again, if you don't know the story, he sold it out of a warehouse on the side of I-45 in like one of the worst neighborhoods. He has built this massive furniture empire out of this one warehouse.
Man, it's a palace now.
It is.
It's
he has done
gorgeous.
It's still in the worst part of Houston, though. I-45.
True.
Anyway, so yesterday, of course, the big news, the Federal Reserve coming out and initially had come out, hike 75 basis points as expected. The statement was pretty much kind of right in line with what everybody thought. And, the initial kind of view is that this was kind of that early, starting to soften the pace of rate hikes, 50 basis point rate hike in December, couple in the first part of 2023 at 25 basis points, pretty much all in line. Stocks like that and initially took off. And then Fed Chair Jerome Powell took to the mic in his presser, and everything went to hell in a handbasket in just a few minutes as he was making numerous statements, basically to the point that don't count out yet that we're not going to continue to be extremely aggressive on rate hikes because inflation is just still too high, and we're just committed to hiking rates. And the markets immediately reversed on that, plunged over 2% into the close yesterday. Again, this was the most volatile 90 minutes in market history that we can find, right, going back. So talking more about this morning, of course, Michael Lebowitz. What were your initial thoughts yesterday, and what do you think now?
I mean, Lance, we were talking about this earlier this week. What do we expect from Jerome Powell? And the answer was status quo. His big thing is inflation. That's what the Fed is trying to do. He keeps telling us, almost every Fed speaker keeps telling us they're not going to be comfortable until inflation comes down. So we look at the latest round of inflation data, and it's come down a little bit, but it's not dropping like a rock. And if you look at what the Fed blames that for, they put part of that blame on employment. As long as everyone can find a job and they're getting raises and you got a healthy employment market, they're going to keep spending. Companies will keep raising prices, and you get this wage price spiral, which is what he's so concerned about. So you look at the latest round of labor data, that too is not, it's that, the unemployment rate is near 50-year lows. Jobless claims are up slightly, but they're nothing concerning at all. ADP was relatively strong. That's a precursor to tomorrow's BLS labor report. I think it was plus 226,000 jobs, which is better than what was average before the pandemic. So your labor market is strong. Your inflation is, maybe there's some signs it's coming down. There are certainly some other signs not in the official data. We're seeing that rents and home prices are coming down rather sharply, which is very positive, but that's going to take a few months. So Powell did what, kind of we thought he would do. He would just hold the line. Yes, we're going to keep raising rates. No, we're not going to pivot, and we're going to wait and see, and we're going to wait. But I thought, Lance, the interesting part, so there's about a half hour between when they release the Fed statement and when Powell speaks to the press. And after reading the statement, which just so you know, the statement is the same statement every 6 weeks, every Fed meeting, but they edit it. And sometimes the edits are big, sometimes they're next to nothing, sometimes it's just grammatical type changes to some words. This time they literally just added one paragraph. And that paragraph basically said there are lag effects, there's the potential for financial stability. And I think the statement gave the market some reason to think that the Fed was appreciating that we were, that there are lag effects, that what they did in April and May still hasn't even really affected the economy, and that there is some financial instability, which they have yet to truly acknowledge. So the market took that as, look, the Fed's going to stall soon, they're going to pause, and then they're going to pivot. Powell came out and said quite the opposite. He said, we run the risk that we don't tighten fast enough. We run the risk that we don't keep rates high enough for long enough. I kind of think of this as an analogy. We've been climbing this mountain of Fed rate hikes. And every time we get to the Fed meeting where the Fed reports on their progress hiking up that mountain, the market thinks they're going to hear the Fed say, we're at the top, we're going to start preparing to go down. And every time Jerome Powell says, we don't even know where the top is, we're going to keep hiking upward. So again, the market fell for the Fed understands what's going on in the United Kingdom. They understand that our stock market's down 20%. Look at Fed funds now, we're priced 5%. Isn't that enough? And Jerome Powell said, no, inflation is still very strong.
Yeah, and what was interesting, though, is he actually gave that term. He actually told the market what they wanted to hear, which he said, look, if we over-tighten, it's fine. We've got tools, and to support, he says, if we over-tighten, it's fine. We've got tools to support economic growth. And what that is that's basically the pivot that the market's looking for. They just didn't hear it, because what he's saying is if we hike rates too much, we're just going to hike rates, right? We really have no idea what we're doing. We're just going to hike rates. And then when something breaks, then we'll go back to zero rates in QE. We'll start buying bonds. So, so what the Fed is now relying on is they're hoping that their tools are actually going to work the next time around as well as they've worked in the past. And maybe they will, right? Because the market is so keyed up on looking for this pivot. But, it was interesting. Powell actually said exactly what the market wanted to hear is like, oh, no, we're going to do QE and drop rates back to zero. We're just going to break something first. and that's potentially coming a lot faster than what the Fed may think. I mean, once we get past midterms, we could very well see a very sharp contraction in employment growth, as well as a lot of negative adjustments to a lot of these employment numbers. The inflation data is already starting to crack. If you take a look at rental rates, those are coming down sharply now across the country. And like you said, those are going to feed into the inflation data. That's almost 40% of the inflation equation. That's going to feed in and start to show a fairly sharp drop in inflation. And now we're about 8 months into the contraction in M2 money supply, which has a very high correlation to inflationary pressures. That is dropping like a rock as well. So over the course of the next 6 months, inflation is going to come down sharply as money supply just simply comes out of the market. So, one of the big risks that the Fed runs is that they break something that is of magnitude that they can't fix quickly. In other words, we get into a fairly deep, they're hoping we just get this soft landing or maybe just a minor recession. What they're not counting on is potentially having a very deep recession because they break something economically, housing, credit markets, et cetera.
No, that's right. And the market may do that for them. The market may say enough already, we're getting out. And they may force the Fed's hand to pull the financial instability card and do QE premature to what Powell and the Fed would like them to do. Yeah. And we've seen the market forcing central bank hands before. It's nothing new.
Yeah. And in fact, the Bank of England is set to announce their rate hike here just in a little bit. So we're kind of watching for that as well because, the Bank of England is the one central bank outside of Banks Japan that's already been facing some risk of financial instability. Of course, we talked about previously their pension funds were getting margin calls, and the Bank of England had to step in and start buying longer dated maturities on bonds to try to stabilize what was going on with their pension funds. They're set to now announce their next rate hike or rate decrease. So it'll be interesting to see what Bank of England does, considering that they're already kind of facing some early some early financial instability issues with England. And so we'll see when that comes out. We'll report that to you as well. So just hang around for that. When we come back, we'll pick up some more on, okay, so here's where we are. The Fed has now said all this great stuff, and the market's down 2% yesterday. We'll talk about when we come back from the break, kind of what happens next and where to go to from here. So, all right, don't go away. More of the Real Investment Show with Michael Lebowitz coming right back up after the break.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
The end of the year is fast approaching. What will the new year bring? Join Richard Rosso, Danny Ratliff, and Lance Roberts for our year-end economic review special event, Tuesday, November 15th. How to address higher taxes in the new year. Should you delay your retirement in 2023? What will the midterm elections mean for markets? Register now at realinvestmentadvice.com for our year-end economic review special event with Ratliff, Rosso, and Roberts. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
You have to scratch your head and wonder why Nancy Pelosi on Face the Nation had this to say about inflation.
The fight is not about inflation. It's about the cost of living.
Those are the same thing, Nancy.
The Real Investment Show podcast. Same show, your schedule.
The next iteration of this will be, it's not unemployment that's the problem. It's just that you don't have a job.
At realinvestmentadvice.com.
Anyone can sell you insurance, and they'll gladly take your premium dollars. The RIA Insurance Agency can provide you with insurance solutions tailor-made for your needs and lifestyle. Because everyone's assets are different, let RIA Insurance review what you need to protect and how. We won't sell you insurance, but what you need will be a matter of policy. RIA Insurance Agency. 888-915-0780. 888-915-0780. RealInvestmentAdvice.com. Click on the insurance tab.
Real Investment Show podcasts are now available from Stitcher Smart Radio at Stitcher.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The end of the year is fast approaching. What will the new year bring? Join Richard Rosso, Danny Ratliff, and Lance Roberts for our year-end economic review special event, Tuesday, November 15th. How to address higher taxes in the new year. What will the midterm elections mean for markets? Register now at realinvestmentadvice.com. realinvestmentadvice.com.
You're listening to The Real Investment Show.
So apparently, Japan is set to release the first Godzilla movie since 2016. So in quite a few years. It's apparently going to be the real life history and documentary of the Fukushima accident. So we'll see how this turns out.
Art imitating life.
Well, the one thing about these Godzilla movies is, you have to go back, Godzilla and Rodan when we were growing up back in the, the 50s and 60s and, the black and white Godzilla movies. And they were terrible back then. They were, terrible movies back then. But, we watched them because, they were Godzilla movies. And then they made the one with, who's the guy from Ferris Bueller's Day Off? The lead actor.
Him.
Oh,
I can't think of.
Yeah, I'm drawing. Now I had it just a second ago.
Broderick something?
Yeah, Matthew Broderick.
Matthew Broderick.
So then they made the one with him. That was terrible. So anyway, so now they're coming out with a new one. It's going to be released in theaters next year, so we'll see.
Yeah, thanks for the warning.
Yeah. Theaters are having a hard time getting movies to get
When's
traction.
the last time you went to a movie in a theater?
It's actually been it's been probably about a year, I guess.
Yeah.
And not because it's, COVID or anything like that, right? It's just the movies suck. There's not been, to go, and my daughter and I love to go to movies. That's one of our things that we love to do. We go, especially when like the whole Marvel movies were coming out. We'd skip school and go see Marvel movies. So but they were good movies, right? There just hasn't been any good movies coming out worth spending the money on to go to a theater.
Did you go see Top Gun?
Yeah, we did.
Okay.
I forgot. We did see that one. So at the theater, but that's the last one. Before that, I can't tell you the last movie I saw.
Yeah. We just got out of the habit.
Yeah. Well, no, and again, it's just they're not that. There hasn't been any compelling ones to go see. Now they've got the new Wakanda movie coming out. We'll see. My daughter maybe wants to go see that. We'll check it out. But the Marvel movies have really they've sucked lately too. So
well, sitting through a movie for 2 hours nonstop anymore is no fun. You can't pause it to take care of things like you can on Netflix.
you just get up and walk out and go to the bathroom.
But you miss a piece of the film.
Jeez. You're getting old, Brent.
Yes, I am.
So
gray power.
I know, right? Yeah, see, I'm not really worried about the whole, economy and political environment. I'll be dead soon, so it doesn't really matter. That's all on y'all now. Y'all deal with it. Anyway, for the break, just leaving off talking a little bit about the Federal Reserve, and the kind of the key point here is where do we kind of go to from here? And I thought this was interesting. One of the things that Mike alluded to a second ago was rental incomes, and we talked about that with, in terms of inflation. But it was also a point that Jerome Powell brought up during his press conference. He said, the point at which rent inflation slows is still far away. He says, at some point, you'll see rents coming down. Now, this is a big driver of inflation. And again, we talked about this just a second ago. 40% of the inflation number is homeowners equivalent rent. He's been dead wrong about rent ever since day one. Because when we were first talking about inflation, he was talking about it being transient and that homeowners equivalent rent wasn't rising. So, this was just a transient inflation push and just roll through the economy pretty quick. He was wrong then, and he's going to be wrong now, because if you actually take a look at the month-over-month change in the national rent index, it has now plunged by the most on record ever in a month. The national index fell by 0.7% over the course of October, making the second straight month on a month-over-month decline and the largest single-month dip in the history of the index going back to 2017. So that rental inflation is about to hit CPI here pretty quick, Mike. And, we could see the Fed having to start to change their tune quicker than they expect. What were you about to say? Sorry.
Yes and no. So this was a really interesting part, if you can say interesting, of the Fed of Jerome Powell's press conference. Someone asked him about rental income, that there are signs that it's coming down quickly, and he fully acknowledged that. But he said our preferred means of looking at inflation, PCE and CPI, are calculated differently. And what he went on to explain is that the rental income that you're talking about, that I look at, that is what people should be looking at, is the marginal change in rents. So if your rent got changed, you show up in that data. But if you just signed a lease 6 months ago, you're not going to show up. So it's just looking at the marginal changes. It's looking at a relatively small percent of the population who see their rents change every month or so, right? What he went on to say is that the CPI and the PCI, what they're looking at is not just the marginal, but everyone. So hypothetically, let's say that your rent is due, your rent is coming up now this month. It may still be up 5%. Two months ago, you may have expected it to be up 20%, but it still may be up 5% from a year ago. So what he's saying is we're looking at the whole population of renters, not just those on the margin.
Yeah, but that's not the way the indexes work that he looks at. And so if you're talking about PCE and CPI and trim means and all that, it's not looking at individual month-over-month changes of rent. And it's looking at the trend of the overall measure of rent. It's
right,
not. It's not a month-to-month change on individuals.
It's not the marginal. The rent figures that you're quoting, that I look at, that we all look at, are marginal. How are just those rents that are coming due today changing? Whereas he's looking at the whole population of rents, many of which are not changing month to month. They change annually. So his view is very myopic.
Right, yeah, but I don't agree with that statement because, again, he's looking at PCE. He's not looking at the entire population of rents, right? He may say that, but what he's looking at is trim mean PCE. That's their key measure for looking at their inflation numbers.
But here's the thing to think about, Lance. Yeah. When you measure rents, only 1/12 of them, in theory, about 1/12 of them change on any given month. So their number is muted by by 11/12 versus something that's looking at just the marginal changes. 11 of the 12, if we have an apartment building with 12 apartments and everyone's lease comes up on us, everyone has their own individual month that comes up.
Yep.
And we're looking at the income for that apartment, the rent's only going to go up or down on 1/12 of those. But that's what the month-over-month change in the National Rent Index is telling you. It's telling you that for the month of October, rents fell for that 1/12 of the rental index, right? And for the 1/12. But what Powell was saying yesterday is that they look at the 12/12ths. So 11 of the 12 aren't changing, and the nice thing is it smooths out data. The bad thing is that you miss appreciate the marginal changes.
Yeah, you miss the turns. Then that's the whole point of this is that, he's looking at these annual rates of run, which right now, when you take a look at, kind of the homeowner's equivalent rent, it's not showing any signs of peaking, but all the underlying data is already telling you that over the next 4 to 5 months, that data is going to peak very quickly and start to drop. And the problem for Powell, which is why he was late hiking rates when he should have been hiking rates back in 2020, 2021, and he was late hiking rates, he's now going to be really late cutting rates. And and the problem is that you're going to get forced into a position where you have to cut rates very rapidly because the economy is starting to come apart at the seams. That's the real risk here.
And here's the most important thing for our listeners to understand: the Fed doesn't know what they're doing. And I know that sounds very crass, but go back to 2021 to mid-2021. This is when inflation was starting to tick up, when we had just passed a second round of stimulus for COVID, and the Fed was expecting year-end 2023 Fed funds to be around 0.5%. Right? They're going to be at 5% year-end 2023. They missed the mark by 4.5%. So if you think they know what they're doing, let's just even say June of 2023 or December of 2023, rates could be at 5%, like he kind of alludes to, or 4.5%. Rates could also be at 0.5% or 2%. So, it's the economy is very dynamic. The financial markets are very dynamic, and they change quickly, and they're extremely hard to measure accurately. You can't measure inflation. Everyone has different inflation. Everyone buys different things. You just can't measure it. The Fed will be proven wrong again. The Fed has rarely been proven right. If you look at their dot plots where they think Fed funds rates are going to be versus where they actually were at turning points, they're often quite wrong. They're going to be wrong again. The only question is when and how long do they kind of keep up this hawkish shtick?
Yeah. Well, and again, I think it's kind of interesting here because the Fed does have, the Fed should be aware, and they are aware that, and they've even mentioned that there's this lag effect to these rate hikes. And so you've hiked now 75 basis points over the last 4 meetings. That's the most aggressive rate hiking campaign in history. And what history shows you is that every time you have these very aggressive rate hikes, you have a very aggressive rate cut the following year. So again, because they wind up breaking something and they have to turn around and reverse it. But it would seem to me just from you could sit there and go, okay, look, I've hiked 4 times, 75 basis points. You pause here for a month or two. Inflation's not going to go screaming off to the moon just because you wait a couple of months to start letting some rate hikes catch up with the economy. then you kind of reevaluate. It's kind of like you're speeding down the road, take your foot off the gas a little bit, curve's coming up, you get around the curve, and then you can speed up again if you need to start hiking rates. The problem is they're kind of like a bull in a china shop. I'm going to just keep hiking rates until I see the tree right in front of me. And that's often why, to your point, they're always too late and wrong in their outcomes. Come back. Again, I said we talk about how this is going to affect the market, what happens next. That's coming up right after the break. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The end of the year is fast approaching. What will the new year bring? Join Richard Rosso, Danny Ratliff, and Lance Roberts for our year-end economic review special event, Tuesday, November 15th. How to address higher taxes in the new year. Should you delay your retirement in 2023? What will the midterm elections mean for markets? Register now at realinvestmentadvice.com for our year-end economic review special event with Ratliff, Rosso, and Roberts. realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN at realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And welcome back to the show. So, futures pointing down this morning. S&P's down about 32 points right now. Dow's down about 193. So again, just getting a bit more pressure on stocks this morning following, Powell's comments late yesterday. Market's kind of recalibrating for the kind of the risk-off positioning now. And again, as we talked about at the beginning of the show, from a technical standpoint, markets were rallying nicely. We had this 4-week rally, and now that appears to be over. We broke the 50-day moving average. We broke the 3,800 support level. We're going to retest this morning that 20-day moving average. If we close below that 20-day moving average, then we're going to retest the lows of the markets here that we've had over the last 4 weeks. So again, nothing really kind of great looking in the markets right now. Heading into the end of the year, as we talked about next week, we have midterm elections. Potentially some good news there for markets if we get gridlock, kind of start to slow down any potential threats of, further, kind of inflationary issues coming out of Washington in terms of more checks to households and those type of things. Of course, also, any type of new tax hikes or anything like that might be negative for Wall Street. That'll at least get put on the sidelines. That could give the markets a little bit of a breather. Heading into the end of the year, lots of cash on books of mutual funds, hedge funds, et cetera, that have to get put back. So there's some reasons to expect this market could perform a little bit going into the end of the year. Now, we're not talking about the return of the major bull market here, but the market is at risk now because of the Fed yesterday of going lower here. So, Mike, just want to get your thoughts on the markets and kind of positioning now with what the Fed said yesterday and kind of what the next steps might be?
So just really short-term, a couple of short-term things. Yesterday, the market, like you said, just fell out of bed. The S&P was down about 90 or so. The VIX was basically unchanged. So the volatility index, which kind of measures how scared investors are, was unchanged. And bonds were down slightly. They didn't get crushed. So that was just something noteworthy. Today, wake up in the morning, and one of the things I've been looking at over the last few months is not necessarily where stocks are opening up, but the dollar, the VIX, gold. I've been looking at bonds, and they all kind of tell a story together. They're all telling the same story. So this morning, the dollar's up about $1.50, the dollar index. Has been a bad sign for stock markets and for bonds. Bonds are getting hit hard this morning. The VIX, though, is basically flat. It was up a little bit. And stocks are down, but not, what are they down? 30, the S&P's down 30 points, less than 1%. So, I think the message is be cautious. Will we break the lows that we saw, a while back? Maybe. But I think we're more likely to stay in a range here. Maybe we've seen the top of that range, but we're likely to gravitate in a range. And what I think really is going to matter are those key data points. Like you said, the election's a key data point, but I think investors at this point understand the Republicans are going to take enough seats to win, to have a vote now. I think what's going to equally matter is that round of CPI data, which also comes out next week. The prices components within all these different manufacturing surveys, the PCE data, inflation data, which will come out later in the month.
Yeah, employment data on Friday.
Data.
Yeah.
Employment data this Friday. But I think more importantly than this Friday are the weekly jobless claims, because that's probably where we're going to start to see some erosion in the labor market. Those start slowly upticking. So we have two inflation data points before year end. Just CPI and then PCE and all those surveys. And I think what could be really helpful for the market is if inflation really starts coming down. The concern, however, is that it's going to take, we talked about rent. There's other components too that just take a while to infiltrate into the official data. And the concern is this lag effect. And the concern is the Fed's going to break something.
Yeah. Well, it's interesting when you talk about jobless claims, they've been exceptionally strong, but, and it's interesting because, you see these jobless claims exceptionally low levels and you're going, well, there's absolutely nothing wrong with the job market. But every day, today, Morgan Stanley planning to begin layoffs in the coming weeks as deal making slows, according to, Reuters. Right. Friday, Twitter's going to lay off half their workforce, right? So, well, Elon's going to lay off half of Twitter's workforce on Friday. That was like 3,700 jobs. It's Apple. I mean, look, we've seen just, kind of report after report after report. First it was hiring freezes. Now it's talking about job cuts and terminations. But yet we're not seeing those jobless claims numbers turn up yet, which is interesting because that suggests either one of two things. One is that those numbers just haven't filtered through to the jobless claims numbers yet, and they're coming. People are getting laid off, but they don't, when somebody gets laid off from the work, they don't immediately run down to the jobless claims, store and file their jobless claims. It's the unemployment office, not the jobless claims store. Just joking. But they don't immediately do that. Sometimes it takes, they get laid off, they're depressed, they're upset, whatever, and it takes them a couple of weeks. So it takes time for those layoffs to actually show up in the jobless claims numbers. Or it suggests that people are just immediately getting a new job and they don't even have time to go. There's so many jobs out there right now, and this is what the job opening survey would suggest, is that there's so many jobs available right now that if you get laid off from Twitter, you can get a job tomorrow at, Etsy or Facebook or somebody else. But, Facebook and Google and others have all, said, hey, we're not hiring any more people. Walmart, Target, others have all, gone into kind of hiring freezes. So I suspect that we're going to see those jobless claim numbers pick up here in the next few weeks, and particularly as we move into particularly the new year.
Yeah, Lance, the other thing is how good is the data really. So it's one thing to say earlier, I said ADP was up, I think it was 226,000 jobs.
Mm-hmm.
That's a good number. And that compares well to the pre-pandemic years. And it's a great run rate. But if you look at the data, it's almost 100% travel and leisure.
Right.
Those are the lowest paying job, some of the lowest paying jobs in our economy. They're also some of the most temporary jobs in our economy. Most of the other sectors were all plus or minus a little bit. So it's the quality of the data too. And if you're just focused on these key numbers and not diving underneath it, like CPI rental, there's a lot more to the story, and there is erosion in the economy, but the main headline data points, and those are the ones that the newspapers, the big media outlets report on, are not deteriorating. But there is a lot of deterioration underneath the surface, and eventually it will show up. And that's what we're going to keep looking out for, is not just what is the number, but how good is the number? Is there quality behind it, or is it really warning that that things are going to really decline quickly with a lot of this data, which in turn will get the Fed to start thinking about pausing and eventually pivoting. Pivoting's a way off, but at least pausing and seeing how much they have truly damaged. They have caused. They don't know that.
Yeah, I know, and that's the problem. It's like you can have erosion underneath the surface of a road for a long time. You have water running underneath the road, and everything's fine. Everybody's traveling down the road. It's all great, and then one day there's a massive pothole right in the middle of the road, right, or a sinkhole. And that's what happens. It'll literally feel like in the economy that it happened overnight. It's like, oh my gosh, what happened? Right. But again, to your point, the data has been telling you this is, the economy is slowing down. We're starting to see cracks in a lot of different facets. We're seeing it in the earnings reports. We're seeing slowdown in sales. We're seeing a slowdown in earnings. Outlooks are deteriorating for these companies. And take a look at CEO confidence. It's at the lowest level since the financial crisis. And you've never had CEO confidence this low without having a spike in unemployment and a recession. So, and again, not to even mention all the yield curve inversions that we've got going on, which is all telling you there's a problem economically.
Right. And that's a huge point. Let's just look at earnings. Earnings per share are down a little, but the outlooks are horrendous. Mm-hmm. The outlooks are where we're at now. The earnings are from 3-4 months ago. These earnings are old news already.
Right.
Right? They're from July and August and September. They're from last summer when Fed funds were at least 1%, 1.5% lower than they are today, when interest rates were much lower, when there were still people taking out mortgages. Mm-hmm. So it's yes, the earnings are very important, but their outlooks are more important. And their outlooks, by and large, not all of them, are telling us that there's problems ahead. Just like all this data is telling us, this rental data is telling us there's a problem ahead. So it's not hard to see it, but it's not going to be just right in our faces. The media is not going to do a great job of reporting it because the headline data that everyone is so focused on is still good. But again, like you said, Lance, underneath the surface, it's deteriorating at a pretty rapid pace. So
I just to navigate away from that for just a second as we get ready to wrap up the show, I just saw an ad on television that SoFi, which is the technology fintech company, they're now going to pay off $1 million worth of student loans. So I just pulled up a quick chart. This stock was trading at a high of over $60 a share. Back in 2021, it's now trading at $6 a share. They have negative $387 million in income, and they're going to pay off $1 million worth of student loans. Maybe you better focus on your own business before you're paying off student loans for other people. Wow, what a disaster. Yeah. There's a lot of disasters out there right now, but there's a lot of, but with that comes a lot of opportunity. Yeah, that's absolutely right. All right, that wraps up the show for today. Thanks, Mike. Appreciate it. Be sure and get by the website. Mike's latest article is out on the website right now, realinvestmentadvice.com. While you're there, also check out our daily commentary. We've got some comments today about the markets and the Fed. It's in our daily commentary that's on the website now, realinvestmentadvice.com. And of course, if you have any questions or comments for me or Mike, be sure and send them. We're always happy to answer them. realinvestmentadvice.com. See you back here tomorrow.